Let's come back to the slides. We have a new topic now. Let's look at the bond price movement. We have known how to describe stock price movement. Now let's look at how to describe bond price movement. They're very similar to each other. This figure demonstrates the bond price movement of these bonds. This is a treasury bonds issued in 2015. 21 means the 21st batch of treasury bonds issued in that year. And this is the dates. And this is the bond price. For most of the situations, bond price is the percentage on its face value. And when we see the close price here, we know that this is a bond in exchange bond market. From this graph, we can see that the bond price goes in an upward trend. This is a treasury bonds. Well, this is the Python script. We use the command exchange bond price. This is the code of the bond, and this is the period. And this is the starting period, and this is the end date. This is the start date. This is the bond code. This is the Python command. This is a variable. Its content is the bond price returned by this Python command. We can see this in Jupyter Notebook. Let's copy this command first to Jupyter Notebook. Yeah, we have the picture. Now we expect to see the bond price, the most recent situation of the bond price. We update the end date to today, which is 2022, July 18th. Let's see the situation. Wow, it's in a more complicated trends. When we look at from the beginning of 2021, the bond's price is in an upward trend, but now it's a little bit downward trend. Not sure about that, unless we have more information. Let's see another interesting situation, which is a convertible bounce. We see a very strange situation here. So before this date, it is the roughly in May 2021. Before this, it's relatively in a flat situation. However, after this time points, the bond price rise in a very sharp way. This usually means the convertible bonds now is close to the conditions where we can convert the bonds into stock, and in the same time, the bond issuer's stock price is in a good trend. It means an upward trend, where we can convert the bonds into stock, and in the same time, the bond issuer's stock price is in a good trend. It means an upward trend. And after a holder convert the bonds they have into stocks, they will have an immediate earn. This will promote the bond price goes up sharply. Because the bond's market value goes up sharply. And after that, there is a downward trend. Probably it's too high already. So it should be an adjustment. We don't know the situation after that. Okay, then we can have an update on that. This is the Python command, and we can have an update. Let's see what happens after that. In order to see the situations after that, we can update 2022, July 18th. Let's look at the situation. Okay, so let's look at several critical points here. So we have a turning point here. It's close to May 2021, and something very good happens in market. In this way, the bond price goes up like a rocket rise. Then there is an adjustment, but now down. So it's adjustment around here, and down and up. That means the bond issuer stock price is in good trends. It's after this critical point, this means if bondholders sell or convert their bonds into stocks, they will have a good earnings. This means the market value of the bond goes up sharply. So this is a relatively longer view about the bond price trend, starting from 2021 January to 2022 July. Let's look at this. The bond price before the turning points is not very high. It's roughly about around 150. And after that, the average bond price is roughly here. It's around 350. This means a big change on the market value of the bond. This is because the option in the bond. So this is the great advantage of a convertible bounce. However, if the bond issuer's market stock is not in a good trend, I believe the bond's price will still go this way. Yeah. So this part of the picture we can regard as the risk premium of the convertible bonds. Risk premium. That means the premium brought by the option in the bond. Okay. This is our understanding about convertible bonds. And similarly, in this way, a convertible bonds is usually riskier. Okay, this is about convertible bonds. Up to the date, we have done that. Now let's move to next topic. Next topic is relatively complicated in the whole module 2. In these topics, we will talk about the influential factors to bond pricing. This means what are the critical factors that can influence a bond's price? And we have 5 conclusions here. These are described as Mokia's law, number 1 on bond pricing, number 2, number 3, number 4, number 5. Of course, these laws on bond pricing were proposed by a guy called Mokia. In order to understand Mokia's laws on bond pricing, we need to have a further understanding about yield to maturity, YTM. Now we have the topic about YTM. YTM literally means yield to maturity. Our questions in this topic is, what is YTM? And why is it important? First, let's have a definition about YTM. And in the definition, we will also introduce some of the new concepts. YTM usually represents the rate of a return for a bond. Okay, first is a concept of return. Here we have the word yield. Yield is actually the same meaning as the word return. However, as an industrial habit in bond trading, people are more likely to use the word yield rather than return. I believe this is a business convention. And the rate that the bonds would earn if they buy a bond and hold until maturity. So YTM, we have three keywords now. First, it's a rate of return. Second, the bondholder would earn if they buy a bond and hold until maturity. So it is earnings in the future. In this way, YTM could be calculated in this way. First is the future earnings, the income from holding a bond till its maturity, and then the cost, price of buying a bond. Of course, this price would be a market price. However, in the income from holding a bond till maturity is a complicated concept. Let me explain why is it complicated. This is a time axis, or we call it dates. Suppose here is the maturity of a bond. And this is the time point where an investor buy a bond. These are the coupon dates where we have interest, or called coupon interest. We have coupon interest, and at the time point of maturity, we have two incomes. First is coupon interest, and then we have the face value back. Face value back. And at this time, we spend money to buy a bond, which is the price we have. So YTM would be the income at the same time point of price divided by price. YTM would be the income divided by price, right? However, the income here is complicated. Why? Because the income here, we should take the same time point with that of the price we spend in market in order to buy the bond. In this way, our future income should be all converted into the time point here. We have to convert it. Convert. How do we convert this? For example, this is one interest period, and we suppose the market interest rate or the discount rate is R, is a small r, and we suppose the coupon interest is a variable C. So for this one, how can we convert back? We have C divided by 1 plus R, right? And for the second coupon time, we could have C divided 1 plus R bracket square, right? Suppose this is the N. And at the time point of maturity, we should have two cash flows. One is C divided by 1 plus R square N. Also, we have the face value. Suppose it is F, 1 plus R square power N. And in order to calculate the time point, the income at this time point, we should add all these together. This should be the income. This process, we call them discounting. And the discounted value, we call them present value. Or in short, PV, present value. This is the present value of the first term coupon interest. This is the present value of the second term of coupon interest. This is the present value of the cash flow we have at the time point of a bond's maturity. In order to calculate the income at the time point when we buy the bond, we need to discount all the future cash flows of holding these bonds into its maturity back to this time point. Then we use these two values to convert YTM. So let's have a quick review on this. YTM is the rate of return when an investor buy a bond and hold it till its maturity. In this way, we have two things we need to calculate. First, what is the present value of the future earnings for the investor to hold these bonds till its maturity? We need to use the concept discounting, and we need to discount all the future cash flows back to now. That means we need to calculate the present value of all future cash flows. Then we divide the income by the price or the cost we pay in order to hold these bonds. So this is YTM. Do we have any questions? If we have, welcome you to propose your questions in our course WeChat group. Next, I'll show you why YTM is so important in bonds pricing models, or why YTM is important in bond tradings. Suppose we have a theta board here. We have a theta board. And on one end of the theta board, which is the bond yield, or YTM. Another end of the theta board is the bond price. So for this theta board, we can see that if YTM goes up, then bond price will go down, definitely. If YTM goes down, bond price will go up, definitely. So YTM and bond price, they are in the two sides of a theta board, respectively, and they will move in opposite trend or opposite directions. They move in opposite directions. One up, another down. One down, another up. So this figure demonstrates why YTM is so important in bond trading. Now we have understand YTM, and we can begin to discuss the first law on bond pricing, which is the Morkew's law number 1 on bond pricing. Well, the question in this topic is pretty simple. What does Morkew's law number 1 describe? Morkew's law number 1 on bond pricing describes the relationship between bond price and YTM. We have an illustration on that. Suppose we have a bond. Its face value is 100. Its coupon rate is 7%. Its annual payment of dividends means redemption is 2. And maturity years is 8. YTM is 6%. Now we have YTM here. This is YTM. And this is bond price. In this way, the figure can demonstrate the relationship between YTM and bond price. Suppose we increase YTM in this way. Here we have plus 5 BP. BP here means base points. This is another professional term frequently used in bond pricing and also used in interest rate management. Base point. 1 base point equals to 0.01%. This is base point. We increase YTM by 5 BP, by 10 BP, by 20 BP, 50 BP, 100 BP. And in another direction, we decrease YTM by 5 BP, 10 BP, 20 BP, 50 BP, and 100 BP. And in this way, we can compare the movement of bond price. We can see that when we increase YTM, bond price goes down. At the beginning, goes down slowly. Then after some points, goes down significantly. When we decrease YTM, we find that bond price goes up. Within certain points, bond price goes up slowly. After these points, bond price goes up significantly. So we have another conclusion. Our first conclusion is when we increase YTM, bond price goes down. When we decrease YTM, bond price goes up. Of course, we have a preconditions. All the other conditions remains unchanged. This is our primary conclusion. Then we have a secondary conclusion here. We find an interesting period or an interesting range of YTM. During this range, when we change YTM, bond price change slowly. Beyond this range, bond price change quickly. Beyond this range. This is beyond the range. This is beyond the range. So in this way, if you were a bond trader in the future, if you understand this, you are very sensitive to interest rate changes because YTM always follows market interest rate. Whenever you see a market interest rate changes, you can quickly have a prediction on the moving trend of bond price. If you see market interest rate gets lower, you can quickly have a prediction on bond price moving trend, or bond price will goes up. If you see an interest rate increase in market, you will have another prediction on that. Okay, bond price will goes down. Bond price will goes down. When bond price goes down, some of the investors who look for higher returns, they will leave bond market and go to stock market. What does that mean? Usually under such kind of situations, bond market will probably go into a bear market, when stock market probably may go into a bull market. So this is the great implication of interest rate. This is the great implication of interest rate. Therefore, next time, whenever you see market interest rate changes, they not only affect the situation of bank lending or bank loan or borrowing cost or capital cost, but also they have implications on bond market as well as stock market. After this course, I believe you will have such kind of understandings about the implication of interest rate changes. This is a theoretical model on how do we calculate bond price. There is a general rule on evaluating the value of a securities. The price of a security product should equals to the present value of all its future cash flows. Again, I repeat, the current price of a security product should be equal to the present value of all its future cash flows. What are the future cash flows of a bond? First, open interest. Second, its face value. If we discount all these future cash flows, it should be its price. This theory not only eligible for stock, but also to bond, to fund, to option, to future, and all financial products. But for different products, their future cash flows are in different forms. For bonds, it is quite clear, so it's relatively easy for us to determine the price of a bond. However, for a stock, it's very difficult for us to describe its future cash flows. We don't know about the future dividends. Okay, so it's very difficult for us to to describe the price of a stock. Now let's look at this teeterboard again. From this way, we can understand that the relationship between YTM and bond price is just like the two ends of a teeterboard. The bonds yields rise, the bonds price fall. Okay, the bonds yields fall, the bonds price rise. If you remember this picture, I think it is very helpful if you do a bond trading in the future. Well, this is the case script. In the case script, we have two Python commands. The first one, we define YTM and its changes to two sides. Okay. From here is the side we increase YTM by 5 BP, 10 BP, 20 BP, 50 and 100 BP. And from this side, we decrease the YTM by 5 BP, 10 BP, and so on. So in Python, we call this a list. In the list, we can have lots of elements, not only the elements of values, but also elements of strings. For example, we have a gender list equals to, okay, first it's female, and then it's male, and third unknown. We can have at least 3 elements, right? And this command is a Python command called bound-moq1. This command used to describe or demonstrate the first law in bond pricing proposed by moq. And this one is the current YTM. And this one is the maturity. And this one describes the coupon rate. This one is the face value. This one is the redemptions, number of dividends issued every year. This one describes the changes of YTM. You can change these parameters and see how the moq's law number 1 changes. Actually, there were not much changes because moq's law number 1 have been proven for many years already. So let's try this. Copy it into Jupyter Notebook. Let's do it. This is pretty quick, right? Okay, from this picture we can see this is the range of YTM. Where when we change YTM, bonds price change slowly. In this way, this is a relatively steady period, the steady range when we have YTM changes or when we have market interest rate changes. So let's calculate what is the range of YTM here. It is 6%. Now we have plus 20% means 6.2%, right? 6.2%. This is 6% minus 20 BP is 5.8%. This means when market interest rate or bonds YTM changes between 5.8% to 6.2%, bond price will not change dramatically. It will only change a little thing. Let's look at this. It is about 105 here. This is about 107.5. So when YTM or market interest rate change from 5.8% to 6.2%, bond price, this bond price may change from 105 to 107.5. Within this range, it is less risky. However, once YTM changes beyond this range means this way or this way. bond price will change dramatically or will change significantly. So if you are a bond trader in market, you understand this range of YTM is critically important for you to understand the future changing trend of a bond. Okay, these are we can call these critical points as well. Then let's try to change some of the parameters of the bond. For example, okay, we change the coupon rate from 7 to 8. And we change the redemption, means number of dividends a year, to 4, from 2 to 4. And we change the maturity from 8 years, for example, to 20 years. Okay, we have changed a lot. Then let's see what happens. This is pretty interesting. Let's find out. First, the range of YTM still between 5.8% to 6.2%. These are a safety range. Within this range, whatever YTM changes, the bond price actually changes at a very slow pace. The other things, we don't find them change too much, right? Of course, the bond price changes. Say, this is about 126, and this is about 122. As we have changed some of the parameters of a bond, although the range of YTM does not change, but the range of bond price in correspondence to the range of YTM already changes. That means when we change YTM from 5.8% to 6.2%, bond price will change from 126 to 122. Okay. Then let's have other changes. This time, change it in another way. For example, we change our YTM from 6% to, suppose we change to 8%. And we have more range of our bond price changes, for example, minus 200. And we have positive 200. And also we change to, we find that the redemptions does not matter in law number 1. Now, this time, let's look at the situations. Okay, this time we find some changes over. This is our anchor points about YTM. Our anchor point of YTM. Okay, now let's look at the range of YTM from here, right? Okay, this is 8% minus 20 BP, 7.8% here. Here we have 8.2%. 8.2%. Now we find that if we change the anchor point of YTM, the range of YTM also changes. However, we find that the range of YTM is, we find the rule is minus and plus 20 BP, roughly about 20 BP. So this time the range is the anchor points minus 20 BP and plus 20 BP. But I must say that these findings is only applicable to these bonds, and similar bonds may not be applicable to all the other bonds. So in order to find out the rules of the range of YTM, you have to do similar jobs and find out. And let's see this time, what is the range of bond prices? Here, it is roughly about 94. And we have here it is roughly about 95.5. So for this bound, if YTM changes from 8.8% to 2.2%, bound price will change from 95.5 to 94. So you can find out the range of YTM. We have changed 0.4% altogether, while the bound price just changed 1.5. Okay, very small range, very small range. Okay, you can practice other similar parameters for the bound and find out the changes in the Mokyo law number 1. These parameters, you can change all of them. But remember to keep a reasonable relationship between these parameters. Okay, do we have any questions? If we don't have questions, let's have a 10 minutes break. See you after the break.